Hey everyone, it's Kenji here from YouTube channel Kenji Explains, and I've partnered with Money Under 30 to create a series of videos, and this one's going to be on zero commission brokers and how they make money. So I'll break the video down into three main parts. Firstly, we'll define what zero commission brokers are. Secondly, we'll go over how they make money given that they don't charge a commission. And then lastly, we'll go over some of the things to consider when choosing a broker. So firstly, what are zero commission brokers? And before we get into that, we need to define what a brokerage firm is. And in short, a brokerage firm is a company that executes trades on behalf of its clients. Most everyday investors, known as retail investors in finance terms, need the help of a broker to access major exchanges like the New York Stock Exchange or the Nasdaq. The broker takes these orders from the customers and fulfills them at the best price. These can be straightforward trades like buying or selling stocks, to more complex ones like options, futures, and other derivatives. Traditionally, brokers were compensated for this service at somewhere around the $10 per trade. As you can imagine, this was particularly painful for small investors, where maybe you bought $100 worth of a trade, and automatically you'd already lost 10% of that investment because of the upfront commission. But luckily for retail investors, the rise of online brokers has transitioned the industry from a commission per trade model to a zero commission model. This is in part due to Robinhood, a financial services company founded in 2013 with the goal of democratizing access to the financial markets, which traditionally was mainly for the wealthy. If you fast forward to today, they're among the most popular brokers, especially for the retail investor community. The company has grown its revenue from 2.9 million in 2015 to 959 million in 2020 and has grown its customer base to over 22 million active users. But what's been interesting is that as the likes of Robinhood started to offer commission-free trades, more established players like Charles Schwab, TD Ameritrade, and E-Trade, which have client counts in the millions as well, all actually made the switch to commission-free trades, basically in an effort to stay competitive versus the industry newcomers. But this industry shift hasn't come without some controversy. Zero commission trades mean that it's a lot harder for retail investors to resist that temptation to trade. With the old commission fee in place, everyday investors would have thought twice before they actually executed a trade, while nowadays it's just so much easier because there's no longer that filter. This has raised some concerns among regulators, especially as more uneducated investors started trading. Similarly, there's been a rise in gamifying investing by making it more friendly and fun. For example, the Robinhood app is very user-friendly and very beautifully designed, and even used to have confetti pop up every time a customer made a trade. This feature was later removed as it came under scrutiny by the financial regulators for gamifying investing. Overall though, zero commission brokers have been an excellent addition to the industry. That said, investors should still be mindful of being impulsive and overly emotional when trading in the markets. Now that you have a better idea of the brokerage industry and specifically zero commission brokers, you're probably wondering how they make money. After all, they're not non-profit organizations, so let's look into it. So we'll look at three main ways that zero commission brokers make money. The three we'll look at are interest on customer deposits, payment for order flow, and margin trading. You're probably confused about what some of these mean, so let's take a closer look at each. So the first is interest on customer deposits. Brokers that provide commission-free trades typically pay account holders very little interest on their idle balances. But while they pay you very little in interest, they then use that sitting cash balance and put it into something that's going to give them a higher return. This business model is actually very similar to that of a traditional bank, where on the one hand, you're going to deposit your money in there and you're going to be given a very small interest. On the other hand, they're going to take that money and lend it out to somebody else that say wants to have a mortgage for their house, and they're going to charge them a much higher interest, and so they're going to be profiting off that spread. The second method that zero commission brokers make money is through payment for order flow. I know that sounds a bit confusing, so let me explain. It's basically when the broker receives compensation, so payment for directing those orders, so that's the order flow part, to a particular market maker. Now this market maker is the one that's actually executing these trades, and they make money by the difference between the bid price and the ask price. And at this point you're probably wondering, what is the bid, the ask, and the spread? In short, the bid is the price that the market will buy your share for, the ask is the price that you pay for that share, and these two have a spread, so a difference. The bid price is always lower than the ask price, which to us investors that means that we're always paying more and we're getting less, so we're essentially losing money on each trade. These market makers make money from that spread. Usually it's just a few cents or less per order, But if you have enough volume, so enough number of orders, that obviously starts to become big money. And that's why they gave the broker a payment in exchange for order flow, hence the name payment per order flow. Similarly, for the broker, with enough volume, so enough number of trades, that revenue starts to become significant. For example, looking at Robinhood's first quarter financial statements, you can see they had 420 million in transaction-based revenues, which refers to the payment for order flow. The figures here are in thousands, by the way, so it's 420 million. Now, looking at this from the retail investor's perspective, so our perspective basically, if a trade has high liquidity, meaning that it's a very popular trade, like say buying or selling shares of Apple or Amazon, that's going to have a very small spread because it's very easy to find a buyer and a seller. On the other hand, for investments with low liquidity or less popular trades, like those of companies with a small market capitalization or more complex products like derivatives, it's a lot harder to match a buyer and a seller, and so that spread is going to be a lot higher. The last method we'll look at is borrowing fees or margin trading. When customers short sell, they hedge, or they perform any other activity that's going to require borrowing, then the broker is going to charge a fee for that. For most traders who don't use margin, meaning that they don't borrow any money, this is not going to make a difference. But if that's your case, if you typically have a higher appetite for risk, and so you decide to borrow money as well, this is something to be mindful of. So these are some of the ways that zero commission brokers make money. Keep in mind that these aren't exclusive to zero commission brokers. Some traditional brokers may also make money this way. There are other services as well, like premium subscriptions that might give you access to research reports and things like that we didn't cover here. Now that we have a better understanding of brokers and how even zero commission brokers make money, let's look into some things to consider when choosing a broker. The first consideration is your cash balance. If you're somebody that likes to have a large amount of cash sitting in your account, just in case of a big trade opportunity coming up and wanting to invest in it, then it probably makes sense to look for a broker that's going to be paying you a high interest. On the other hand, if you have very little cash sitting in your account, then you're probably indifferent between one broker or the other. The second consideration is your trading volume. If you're somebody that trades with little volume, you're probably indifferent towards paying an extra penny per share each time you buy or sell a stock. However, if you trade with a higher volume, like say in the thousands or even in the millions, for example, then you might want to take a closer look at the true best price when buying or selling a stock. After all, an extra penny scaled to 1,000,000 shares is an extra $10,000. Lastly, if you're an advanced investor using complex products or trading strategies, then you're probably going to want to consider the borrowing fees and other fees associated with things like hedging, short selling, or arbitrage. While we've looked at some things to consider, it's not uncommon to actually have more than one brokerage account. For example, you might have a more conservative approach in one account where you have the majority of your money, and you might have a more high-risk experimental approach with another broker where you have a small portion of your overall portfolio. Every investor out there is going to have their preferences, as it's probably going to be your case, so make sure you do your research and choose a broker that best fits your needs. That's all for this video. If you enjoyed it, you can see some of my other videos on my YouTube channel at Kenji Explains. Alright, see you in the next one.